At RSM, we instill confidence in a world of change. Because when you have confidence, you can act with complete conviction for the future. And in our ever-changing world, with transformation happening at a rapid pace, the depth of insight and understanding we bring matters most. At RSM, we believe the biggest opportunities are found by paying attention to the smallest details, finding difference through understanding, and anticipating the challenges of tomorrow, helping build long-term value today. At the heart of RSM are our people, whose talents, ideas and energy drive us forward. A collective of 60,000 curious minds, pushing innovation in over 120 countries. Combining local knowledge with global insights, we harness data and real-world experience, building trust that's unmatched and confidence that grows, working together to look further, giving you what you need to take charge of change. At RSM, we instill confidence in a world of change. Because when you have confidence, you can act with complete conviction for the future. And in our ever-changing world, with transformation happening at a rapid pace, the depth of insight and understanding we bring matters most. At RSM, we believe the biggest opportunities are found by paying attention to the small details, finding difference through understanding, and anticipating the challenges of tomorrow, helping build long-term value today. At the heart of RSM are our people, whose talents, ideas and energy drive us forward. A collective of 60,000 curious minds, pushing innovation in over 120 countries. Combining local knowledge with global insights, we harness data and real-world experience, building trust that's unmatched and confidence that grows, working together to look further, giving you what you need to take charge of change.
Good afternoon, everyone. Welcome to our webinar today. My name is Jelita Anggraini. I'm the Transfer Pricing Manager here, and I will be your moderator today. And today we will talk about the Transfer Pricing Update Regulation, PMK 172. As you already know that we have the new regulation and will be in force for fiscal year 2024. But first, let me introduce our firm. I will share my screen. I believe that you all can now see my screen. At RSM, we help clients to overcome new challenge, embrace change, and adapt to thrive by working together, creating that insight, combining world-class technology and real-world experience. We deliver understanding that unmatched and confidence that builds for a changing world, for the future, for all. Here and in RSM International, we are now the 6th largest global assurance tax and consulting network. We have 64,000 people worldwide working and 120 office in 1,820 office, in 120 countries. We have more than 35 years of presence in Indonesia, and we are now integrated professional service firm assisting our clients in assurance, tax, and consulting. And we are proud to say that we are now considered as the 5th among firms alike in Indonesia. We have currently 700 staff, 40 partners, and 2 offices here in Indonesia. Our service here in Indonesia consists of accounting and reporting advisory, audit, business and corporate services, corporate finance and transaction advisory, governance, risk control consulting, management consulting, tax and technology consulting. In tax, we also have business tax, international tax, merger and acquisition, and of course, transfer pricing. Today, we will discuss about transfer pricing updates in Indonesia. Our speaker today is Salil Goyal and Kivi Hadi Daholi, our tax partner. Salil Goyal is a partner for tax practice, and he is the head of TP at RSM here in Indonesia with more than 15 years of experience and 12 plus years in transfer pricing. He is experienced in price modeling, supply chain and value chain analysis, price setting, testing exercise, and has been providing tax advisory to a wide range of multinational companies. He is a chartered accountant, Bachelor of Commerce, and hold advanced certification in international tax and transfer pricing from Leiden University, the Netherlands, and the IBFD. Our second speaker is our tax partner, Pak Kivi Hadi Daholi. Kivi is our transfer pricing partner in Indonesia with more than 15 years of experience. He has expertise and profound knowledge in transfer pricing and international tax. He completed his associate degree at Sekolah Tinggi Akuntansi Negara and have bachelor degree at Universitas Sumatera Utara, both in Indonesia. He then continued a master degree in Birmingham Business School, University of Birmingham, England. I will guide you through our webinar guide. You can submit the question through the chat box on your screen. And the question can be delivered in Bahasa Indonesia or English for your convenience. Me, as a moderator, will lead the Q&A session. The questions are expected to be short, concise, and clear using polite words. Our slide can be downloaded after you complete the feedback form, and the feedback form link will be shared through your chat box. First, presentation will be delivered by Salil Goyal for the application of arm's length principle according to Minister of Finance Regulation number 172. Salil, the time is yours.
Thanks, Janita. And good afternoon, good evening, good morning to all the participants from wherever you are joining. And we are glad at RSM to provide updates from our perspective related to the recently issued regulations on 29th of December. I think the way we want to structure this presentation, we will discuss about application of arm's length principle, largely in this session, and then followed up in the next session, largely on the dispute resolution and other perspectives related to the regulations. Next slide, please. So before we jump, we'll just give you an overview. The regulations contain information related to the special relationship related to where the transfer pricing regulations are expected to apply. Then the application of arm's length principle. This is where we believe that for the purpose of this webinar, in the session 1, we will focus on these on specific articles related to this portion of the regulation. This portion of the regulation is covered in Article 3 to 50, and we will be largely covering some select articles so that we can present our various challenges or various points related to the observation on those parameters. Then we will have a very brief discussion on the transfer pricing documentation changes. And then I think the next 3 portions related to compliance testing by DGT, corresponding adjustment and dispute resolution will be discussed by my fellow partner. Next. So how does the regulation fare related to application of arm's length principle? The first section I wanted to discuss is related to the comparability analysis, which is covered in Article 8. First of all, the comparability analysis regulations, a large portion of the regulations overall has been, based on the international best practices, followed by OECD, UN, and even some of the, regulations of some developed countries, which already have very elaborate rules, especially, so the reference is made to those regulations, and this is how the comparability analysis is also drawn. So it emphasizes so I'll discuss on the key aspects. So comparability analysis has been there previously in the regulations also, but here they have made some specific updations. First is related to the application of reliable adjustments to promote the comparability between the otherwise tested party transaction and the comparable data. So I think this is a very welcome regulation which promotes the use of characterization of the transactions, which you will find in the detailed regulations. There are specific sections which talks about which focus on characterization of transactions based on the factual circumstances. And so they say that if you have data available to compare the transactions, then you should use that. Firstly, you should characterize the transaction. Let's say if it's when you have a transaction between a party in Indonesia, let's say to a party in Singapore. Firstly, you characterize what the transaction is. Let's say the transaction is related to contract manufacturing done by Indonesia. Then you see that Indonesia is performing a contract manufacturer, and maybe Singapore is performing as a fully fledged manufacturer or a fully fledged distributor of the products. So the first step is to first change is to recognize those characterizations, and then looking at the simplification of the functions performed, you should characterize the transactions, and wherever comparable data is available, you should modify the transaction. You should apply the adjustment to compare the data. Let's say, for example, if let's flip the circumstances. If the Singapore is a contract manufacturer for Indonesia, then the guidelines also promote that you can also use Singapore as tested party and make reliable adjustments to the Singapore, to the comparable data based on Singapore transactions as a contract manufacturer, and continue from there. They also suggest that geographical compatibility is which is in line with the first point, that should be applied. Let's say if you select Singapore comparables, then you should also let's say if we are testing the transactions for Indonesia or Singapore, you should accordingly select, if you're testing Indonesia, then you should select, focus should be on Indonesian comparables first. Let's say if you have, uh, because usually in our practice we do not find too many Indonesian comparables, and we have to rely on Asia Pacific search. So the guidelines suggest that if you have a comparable set which consists of Indonesian and non-Indonesian comparables, from Indonesia perspective, you should focus on Indonesian comparables and make adjustments related to Indonesia. Same way, if you use Singapore as tested party, then you should also try to choose comparables. Preference should be given to Singapore comparables, and adjustment should be performed on the related comparable companies in Singapore to make the adjustments, which is a very fair point, and uh, will will help in reducing the disputes around comparability, which is a very major portion of the transfer pricing disputes at tax audits. The guidelines also suggest that where profit level indicators are applied, similar to pricing, whether it at pricing level or at profit or at profit level, profitability level, where you're using profit based methods like TNMM or PSM, uh, you should apply a single year comparable data, unless the multiple data improves the comparability. I think the previous guidelines were not very clear on these perspectives and just mentioned that multiple year data can be relied, and but here it gives importance to the fact that the focus would be on single year data unless you are able to prove that the 3-year comparable data will be helpful. Now, in practice, you will hardly find, let's say, if we are performing benchmarking for 2023, you would, we will look at comparables whose financial year ends as the same with the company which we are dealing with. And usually you don't find 2023 financial statements comparable data be uploaded until the end of 2024. By what time you already need to have a transfer pricing documentation in place. So that created some challenges. So I think the way it needs to be interpreted is you should look at last year last single year comparable data, and if it is similar to the circumstances, and use that to perform your comparability analysis. And where the businesses are seasonal, or where they are in different phases, then 3 years could also help in carrying out the fluctuations or cyclical fluctuations. Let's say in our case, you already have experienced that um, 2021, 2020 was impacted by COVID. So if you select 3 years comparable data, for those years, that may not reflect the COVID impact. So these guidelines can also address some of the tax audits open in relation to those parameters. Then it talks about ALP stages and comparability analysis. This is largely in line with some of the steps which are already part of the 9-step famous approach by OECD contained in para 3.4. So I'm not going to discuss in detail around it. And this is likely to promote, as I mentioned, the appropriate characterizations of transactions and tested party. Because presently we have seen, even if in the past the tested party has been selected as a fully fledged manufacturer, which is not principally in line with the transfer pricing principles. The tax officer does not dispute and carry on the transfer pricing audit based on the documentation prepared by the company. But here it is likely that they will delve into appropriate characterization and tested party issues also. Next slide. So now we go to Article 13, which is another important article which talks about specifically 7 types of transactions which are affected by special relationships, and here the most of them have a service or intangible nature, and the guidelines in line with the global guidelines of many countries and the OECD and UN expect that there has to be some existence and benefit tests to be proven by those transactions to be carried by Indonesian entities if they are recipient of services, and how it benefits them. So for services, intra-group services, there is no major change. They have, described, some of the aspects which are already present in developed guidelines or OECD and UN related to shareholder activities, duplication activities. Some of them were already present in the regulations in somewhere, but they've just collated and given some examples. We'll discuss in more detail when we discuss through an example on Article 14. Then cost contribution, then we will discuss about cost contribution, restructuring, and other financial transactions related to loans, asset transfer, and intangible assets. Maybe firstly we discuss about transactions related to the use of intangible assets. Maybe can you go to the next slide? Okay. Firstly, let's discuss financial transactions first. In the preliminary stages related to financial transactions related to loans, the guidelines suggest that you have to meet a preliminary test of proof that the loan is in substance and actual circumstances existing. It is needed by the borrower in Indonesia. It is used to obtain, maintain, and collect income. So basically, the loan is for operating activities and is, having a purpose, clear purpose. It meets the characteristics of a loan, which is usually, featuring the aspects which contains clear terms of loans, conditions of repayment, values, and the purpose of loans again, and the proof that the loan should provide economic benefit to the borrower. Because we have, often you find that depending on the credit rating of the company, some companies may borrow at a higher rate, let's say 10%, 11%. Now, whether there has been classic debate, followed in the past, where some of the clients usually ask that, can I use Bank of Indonesia rates and those kind of parameters? I think time has come that uh, we need to focus on how the regulations read. They seem to suggest that you cannot just blanketly pick up some reference rate and apply. You have to take a loan. Loan should have conditions, and those conditions should match with the comparable circumstances. Like I mentioned, what are the loan characteristics? The loan should have a maturity date. This is important because in Indonesia there are still loans which are perpetual and which may not have a maturity date, and in practice it becomes very difficult to benchmark those transactions as a loan. So effectively, it has to be treated as an equity. Then there is an obligation to repay the principal of the loan. There are payments scheduled for both principal and interest. So these are the characteristics of loan which will help establish that it is indeed a loan transaction, and there are existing elements of a loan which you would find in practice, maybe from banks and other loan instruments that you would see in practice. Now, some important notes in this regard is Indonesian borrower has to provide financial statements of the lender also to prove that the loan has been acknowledged as a loan by the lender also. So I believe that this is more largely in line, more largely in cases where there has been cases where there is a double deduction. Let's say Indonesia is treating a perpetual loan as a loan, whereas the lender is treating it as an equity, because most probably because the regulations in the other state do not allow it to be recognized as a loan because of the perpetuity and other considerations. So there is a synchronization placed on that front. The characteristic must be clearly stated in the contract. What are the loan characteristics, as we mentioned, point A, B, and C. It should provide proof of the entity who in Indonesia who is obtaining the loan, to prove that they have the ability to take the loan and repay the loan at the time of obtaining the loan. Because often, you will have circumstances where a company is having going concern issues, and largely you will find that in practice it is very difficult to take loans in that circumstances, and the bailout may be may be expected by the tax office to come in the form of equity by the parent. But sometimes, because of the various considerations by the management of the, future perspective of the business and from the repatriation perspective, they still want to continue as a loan. So those things will need more consideration in line of the current regulations. So again, the important question arises is what is the future of perpetual loan from a transfer pricing perspective? I still believe that it will be, challenging. It will be challenging to have perpetual loan unless you have very clear reasons. Why do you want to have a loan which does not have a maturity date and other things? Because uh, the ALP of those loans, even if you take some assumptions which are not in line with the regulations, may not be accepted by the tax office based on the regulations. Next slide. So then the second aspect is that I'm covering is related to transaction related to intangible assets in the preliminary stages. Here, uh, the need is to establish whether the intangible asset exists uh, for which you are, paying for the making the payment. What is the type of intangible asset? Whether it is a marketing intangible or whether it's a trade intangible. Depending on what is the use of the asset by the user. Uh, then what is the value of intangible asset? Again, this is an important aspect that are we paying for an intangible? Sometimes the royalties may exceed the value of intangibles, and in the current circumstances, you would note that some companies, especially maybe in the previous slide, some companies are developing software, especially in the e-commerce front, and where the softwares are not considered very valuable. But let's say if you're paying royalties and continued royalties at a higher rate related to that asset, is it something which is in proportion to the value of the intangible asset? Does it make sense? Is it something indeed considered to be payment in favor of the use of an intangible asset? Who is the legal owner of the intangible asset and the economic ownership? I believe uh, the focus is that, of course, there would be expectation that the legal owner and economic owner should be the same person. But let's say, due to various considerations, some countries try to maintain their patents in their host locations. So the legal ownership they might want to retain at Ireland, but the economic ownership maybe at the level of China, Indonesia, India, or other countries. So the guidelines suggest to say that you need to understand in those circumstances where is the legal ownership and where is the economic ownership, and try and understand the value creation from the respective parameter and assign the intangible returns, that the returns related to the use of that intangible asset also in the similar proportion, largely in favor of economic ownership, and legal ownership should get the value related to or returns related to the legal ownership. For example, if you are just maintaining a patent like I was mentioning, and you just have a compliance person in Ireland to maintain it, so then the value, you cannot say that my IP resides in Ireland, so I need to provide all royalty or all kind of surplus profits to Ireland because this is the entity which is bearing the intangible asset. It does not work like this in the current regulations and also in the updated OECD and UN guidelines. They say that you need to allocate the various aspects of the intangible assets in the form of, as mentioned in the second last point, what are the activities related to the life cycle of the intangible? What activities contribute to the development? What activities contribute to the enhancement of the intangible asset? Let's say software 1.0, software 2.0. 2.0 may be an enhancement. So you may need to see that who is enhancing the asset. Let's say one entity has developed the asset, second entity is enhancing the asset. So you need to be very particular factually in understanding where to attribute the value. Who is maintaining the asset? Like I mentioned in the previous example, if you have a compliance person or a compliance team in Ireland who is just managing the expectation of regulatory body, then it may be something like a maintenance or a protection function. And then who is exploiting the intangible asset. Exploitation may be in the form of where your market is. Let's say, I mean, it brings to an important example, like I think it was raised, a few years back. Like Louis Vuitton may not be a Chinese brand, but the largest consumer market is in China. So it raised an important question whether it can be said that the exploitation of the asset is happening in China based on the users and various tests. So again, these are all factual questions which depends on how you are branding the asset in a country, how you are marketing the asset in a country. So all these points will lead to the decision making. So the economic benefits has to be analyzed in each step related to the development, enhancement, maintenance, protection, and exploitation. And accordingly, you have to provide a value and a expected return or profit to your different entities in different parts of the world, depending on the activity that they are performing in the life cycle of the development of intangible asset. Next slide. Then the other financial transactions, asset transfer, CC, and business structuring, I have just clubbed it together because the expectation is similar for these assets. The proof is and when I say that you need to maintain proofs, the expectation is that you keep this documentation and proofs in your transfer pricing documentation per se. So you have to explain the motive, objective, and economic rationale of why you did an asset transfer, let's say, for example, or why did you engage in other financial transactions or a business restructuring? What is the motive? What is the objective? And is it serving any economic rationale for Indonesia when you enter into those transactions? Whether it is in line with the substance and actual circumstances on the ground related to those transactions. What is the benefit from the asset transfer? And is it really the best choice? Just to give you an example from one of the practical cases I have, helped in this regard. We had a case where intangible asset was in Netherlands related to a product. That product did not had, or the market for that product was stagnated or was going down. And the developed countries wanted to move towards more developed technologies. But that product had its market back in, India, Indonesia, China, and some of the Asian countries. So there was, like I mentioned, this could be a motive, objective, and rational. And why do you want to do an asset transfer from from your related entity? Because then you can buy the asset and value the asset appropriately based on your expected use of that asset in that country and with your customer base and the expected benefits over a period, useful life of the asset. And accordingly, you can do that asset transfer. Same cost contribution asset, again, that if you are going to indulge in jointly developing intangible asset, let's say let me take the example of a pharmaceutical industry. Let's say if you are developing a new drug where the activities are split across various regions, let's say some portion in Africa, some portion in Europe, depending on where your user is, where your tested samples is, or the various parameters around it. You can enter into a cost contribution agreement depending on how different entities have people, facilities, assets which are contributing to the development of intangible, and also the expected use of the asset coming from there. And similarly for other business restructuring and financial transactions. Right. So these are very important parameters, are not very often applied in practice, but when it comes, then these guidelines are expected to help where you need to be, and it is not going to be very easy for businesses, and that's where the importance is to keep in your documentation these points handy, that what is the motive of doing that transaction, keep it in your documentation itself, not waiting for the tax officer to come and ask you, because then they may have lesser reliance. So you need to explain the motive, objective, and rationale of your transactions, whether it and support it with appropriate documentation, board minutes, or various other factors that this was a calculated call with pros and cons identified. What are the benefits that you're estimating from the asset? You can probably lean back to my example, and then whether the asset transfer was indeed the best alternative, or and will it provide a net benefit to you by doing those transactions intra-group. Next slide.
Sorry, Soliel, kind reminder for your time, 10
Yeah,
minutes.
yeah.
Thanks.
Transactions which are not meeting the preliminary stages. As I mentioned, if we talk about the 7 transactions, which also includes intra-group routine services, if the taxpayer cannot provide evidence that the transaction was carried out fairly and it has proper documentation, then or it does not give economic benefit to the taxpayer, then those transactions will not be considered to be at arm's length price. So I think this is very important. The way we are interpreting is previously we observed that the tax officers completely rejected the intra-group services or management services. Now, if you are able to bifurcate, or if you are able to, prove a certain portion of your expenditure, then we anticipate that the tax officer may accept that portion of the expenditure if it is accepted and justified by the tax officer. So they're expected to, if the tax officer is expected to determine the arm's length price. So here the important point is the guidelines are suggesting that where the taxpayer does not agree, it also has to determine an arm's length price of the transactions. So some of the key takeaways that we have been discussing with clients and suggesting to clients, and we have implemented in practice also, is when you have a management service, usually this is widely practiced. Some companies have a very blanket agreement. Some companies are able to manage the detailing. Let's say if the management service is related to 10 parameters, let's say related to HR, HR and administrative activity, related to IT services, related to various other factors. So they are able to pinpoint and divide the entire management services into 10 portions, while you may be able to have more appropriate or more robust documentation and supporting related to the to some of those transactions. These guidelines can be used to maintain a robust documentation in relation to that, and accordingly you will be able to save some of the intergroup transactions where you believe that you have better justification to prove the rationale. Next slide. Now, this one is again very relevant based on, again, from our practical experiences, the arm's length price for permanent establishment. We believe that previously the guidelines also existed, but MOFR 172 requires that the domestic taxpayers who are permanent establishment to submit the information and data related to transactions of their affiliates abroad related to business activities in Indonesia. And if it is not done appropriately, then the tax officer has the power to apply arm's length principle on a suo motu basis. Now, I think Indonesia, with its Indonesia provides benefits, has some special norms also to select industries, and we have often find a lot of queries that if I'm following a special norm where my deemed profit is already fixed, let's say at 15%, what is the point of recording intercompany transactions? Because my CIT will not impact. And in many cases, I've also observed that the companies do not maintain books of account, again due to interpretative issues, because the special norms do not provide specifically for the books of accounts. But our view has always been that the books of accounts is a requirement even for permanent establishments, which is followed from the regulations, previous regulations per se. And this gives more importance because it says that arm's length price for PE should also follow the ALP stages applicable to other entities. So in the current circumstances, previously, let me take it through an example. If you had revenue of 100, you did not recognize, let's say, a lease expenditure for let's say if you're into a offshore drilling service arrangement in Indonesia and you're serving a local PSU, you will record 100 as revenue from your existing customer in Indonesia. You may not record the lease expenses for the rig that you have imported from your parent entity or your affiliate entity, and then you will record only the local expenditure. And then maybe your profitability is 80, but you're not bothered because you are paying tax at a flat rate. Previously also the tax officer could challenge because of that, because the arm's length price is not based on the special norms. It requires you to maintain books of account and can ask that, is your expenditure appropriately recorded? And with these guidelines, it will become even more important. And same goes with some of the questions related to when you have a permanent establishment. The current regulations do not provide that you cannot have a management expenditure, management related expenditure borne by a branch. But now when the arm's length principle for permanent establishment in the regulations do not specify any such things, and it requires them to go through the similar level of testing as other other entities. We believe that maybe it could be a useful thought to see that if a management expenditure is can be elaborated and justified that the branch is in need of those expenditures, maybe it can be taken up with the tax office. Next slide. This is the last slide from my deck. This is related to more of an important perspective. While master file and local file regulations were based on ex ante and required you to have the obligation of preparing them if your previous year thresholds of revenue and specific transactions exceeded the numbers. And now I think the change is that even for CBCR, the similar threshold has been prescribed. So you should start about CBCR also similarly. But important point is that there is an additional point which is highlighted in dark gray, that the party should ensure that there should be a statement submitted that the documentation existed at the time of filing your CITR. So there should be a attestation that or a signed statement letter signifying that the documentation was available and was contemporaneous and was prepared within the time frame. So I think this will be an onerous requirement and would require as most of you would be, starting to, go into your compliance season for your CIT returns and transfer pricing documentations. It is important that you should bear in mind that additionally, there may be a statement letter which may be needed to ensure that you have started and compiled your transfer pricing documentations within the appropriate time as suggested by the regulations. I think that's it from my side. Maybe back to JJ or to my fellow partner Kiwi to take you through the other section.
Thank you, Salio. It's a very insightful explanation and also the key takeaways that you give. I think, we can be more cautious now. And actually, we have one question, but I will keep that for our question and answer session. Yeah.
Sure. Thank you.
Okay. Next, we have Pak Kivi Hadi Daholi to give the explanation. The time is yours, Pak Kivi. Thank you.
Yeah, thank you, Mbak JJ, and thank you, Salil, for your presentation. It's very wonderful presentation. maybe we can give a virtual applause for my partner, Salil Goyal. Okay, thank you. So before we start, I usually open it with pantun. Perhaps some of you already know about pantun. Yeah. Please, if you want, you can say handsome or cakep in bahasa Indonesia. I just prepare one pantun for you. In the forest, the tall trees sway, under the moon's soft silver ray. The arm's length principle we obey, ensuring fairness in transaction every day. Okay, that's the opening from me. Okay, now, thank you. Mbak Fatima say cakep. Okay, right now I will continue the presentation to discuss the DGT authority to assess the implementation of arm's length principle. But before, I will show you a figure, and please, if you can try to guess, what does this figure represent? The first figure is 48%. Anybody have idea? What is this? 48%. 3, 2, 1. Yes. If any of you answer that this is the additional tax burden if the taxpayer did not implement the arm's length principle. So, if DGT come and assess the implementation of arm's length principle, and it is found that the taxpayer did not meet the requirement of arm's length principle, the correction can increase the tax burden into 48%. Where does this number comes? 22% for the income tax, 15% for withholding tax, secondary adjustment, and 11% for VAT, 22 plus 15 plus 11. Maybe after this you will think, wow, it's so high. The burden is quite high, 48%. I will give you the simulation after this. Next slide, please. Yes. This is already stated by Salil. When we talk about the transfer pricing, there is a principle applies for two sides, both of sides, the sides of the taxpayer and the sides of the tax authority. The implementation of arm's length principle already regulated in Ministry of Finance Regulation number 172. Before this, before the Ministry of Finance 172, there are at least 3 Ministry of Finance that regulates the implementation of arm's length principle. The first one is Ministry of Finance 213 regarding the transfer pricing documentation, released in 2016. And the second one is the Ministry of Finance number 4749 regarding the mutual agreement procedure. And the last one is Ministry of Finance number 22, released in 2020 regarding the advanced pricing agreement as well as the norm of arm's length principle. Now, the Ministry of Finance 172 use the omnibus approach. It combines all of these 3 regulations into one regulation. So now if we want to talk about how the Indonesia implement the arm's length principle, we can just see the Ministry of Finance regulation number 172. But internationally, there is a consensus that we will use arm's length principle, and there are at least 2 guidance. The first one is OECD transfer pricing guidelines, and the second one is United Nations transfer pricing manual. Basically, both of the guidance has the same approach. Next slide, please. So as already explained by my colleagues, Salil, I will deliver to you how DGT execute their authority. So based on the regulation, it's already stated in income tax law and VAT, value added tax law, and also in government regulation, and then in Ministry of Finance regulation, DGT has the authority to recalculate income and expense, revenue and expense and recharacterize loan into equity for the purpose of calculating income tax. So how DGT execute their authority? Based on Ministry of Finance Regulation number 172, DGT will assess, first one, they will assess the formal testing or the formal requirement. When the DGT do the formal testing, they will look whether the taxpayer already meet the regulation regarding, first, whether the taxpayer already submit the summary of the transfer pricing documentation. Is it already attached in their annual tax return? Second, the DGT will assess whether the taxpayer already prepared transfer pricing documentation and the content followed the requirement in the Ministry of Finance regulation. So the content of the master file has already regulated in the Ministry of Finance regulation and also the local file. And the third one, the timelines, the timeliness. Whether the taxpayer can submit the transfer pricing documentation within the period of 1 month after the request from DGT. So when the DGT want to assess or want to test the compliance of the taxpayer, and the request has already sent to the taxpayer must provide their transfer pricing documentation within 1 month. So that's the formal testing. That's the first step. When the taxpayer already meet the formal testing, then, or well, the DGT has already do the formal testing, then come the second stages. What is the second stages? The material testing. What will DGT do in material testing? The tax authority will assess whether the taxpayer has already meet the arm's length principle application. Yeah, the arm's length principle application has already been regulated in Article 3 in Ministry of Finance Regulation number 172. So the DGT will assess whether the arm's length application follow the actual circumstances, follow the ex-ante basis or based on the data information available at the when the transaction occurred, and follow the stages in implementing arm's length principle. So there are at least 6 stages in arm's length principle application. So the DGT will assess all of that. Next slide, please. So this is how will be, this is the simulation. When I say to you that there will be an additional tax burden 48%. Assume there are 2 companies. These 2 companies in one group. They have special relationship. Assume there are company A and company B. In their annual tax return, company A said, my sales is 100,000, my cost is 19,000, the profit is 10,000, and the income tax in A is 2,200. Same with company B, you can see how their annual tax return being reported. So the total tax burden for A and B will be 6,600. Okay. There are affiliated transactions between A and B in which the A sells their product to B. The price as reported in their annual tax return is 100,000. Next slide, please. This is the setting the scenes. Next slide. Okay. So this is the first simulation. And then the tax authority comes. The audit comes. Okay. In the audit, DGT found that the price of 100,000 is not arm's length. So it should not be 100, but it should be 110. So there will be a correction for 10,000. Such correction is called primary adjustment. So as you can see, the first one in their annual tax return, the taxpayer said that my sales is 100,000. And then the tax authority comes and said, oh, it's not arm's length. It should be 110,000. So there will be an adjustment in their sales for 10,000. When the sales is increased for 10,000, then the income tax will also be increased. you can see here, the profit increased from 10,000 to 20,000. And then the income tax increased about 100%. Yeah. Now it become 4,400. So there is an additional tax burden, yeah, for corporate income tax, 20%. It comes from 10,000 multiply with 22%. So the company A has to pay 2,200. That's the first one. That's called primary adjustment. And then based on the Ministry of Finance regulation, it said that the discrepancy, yeah, between the arm's length principle applied by the DGT and applied with the by the taxpayer, deemed as dividend, deemed as indirect profit attribution, and treated as dividend. So it will be applies the withholding tax 15%. It called secondary adjustment. So 10,000 multiply with 15%. Yeah, 22 and then 15%. That's secondary adjustment. And the third one, in Ministry of Finance regulation, in the same Ministry of Finance regulation, it reaffirms that the DGT can assess or can do adjustment to the VAT. Yeah. So there will be additional tax burden for VAT, increasing the VAT for 11%. So the total additional tax burden will be 4,800. That's what I say before. There will be additional tax burden for 48%. So you can see here, the additional tax burden will be 4,800, and the total tax burden will be 11,400. Okay? You get what I mean? Okay, next slide, please. Yeah. So, in the Ministry of Finance regulation, it provides more certainty to the taxpayer. Why? Because in the previous regulation, there is no clear statement about the secondary adjustment, about the corresponding adjustment. What is the corresponding adjustment? It's an adjustment performed by the counterpart of the related party to also adjust their annual tax return or to adjust their tax assessment letter. Okay, so in the previous regulation, there is no clear guidance about that. Therefore, after the publication of or after the release of the Ministry of Finance Regulation number 172, there is more clear guidance. There is more clarity here. In the previous regulation, if you talk about the secondary adjustment, there is no clear guidance. When the secondary adjustment arises, what kind of type special relationship can arise the secondary adjustment? Is it only the ownership or also control or also familiar relationship? There is no clear guidance about that. The regulation silence on that. But here, it gives more clarity. So there will be more certainty for the taxpayers. So how the PMK or how the Ministry of Finance regulation regulates such adjustment? In the Ministry of Finance regulation, it said that, one, the secondary adjustment applies for local and for cross-border transaction. That's the first affirmation from the regulation. Second, the secondary adjustment can be waived as long as the taxpayer do the repatriation or agree with the tax assessment letter. Yeah, so the taxpayer do the repatriation and agree with the tax assessment letter. So if such requirement is met by the taxpayer, then the secondary adjustment will be dropped. That's for the secondary adjustment. So here we make the 115 will be nullified. And the second, how about the counterpart? Can they do some corresponding adjustment because of the transfer pricing adjustment performed by the DGT for their counterpart? So here in company B, they can adjust their costs. Because why? Because the sales from company A become the cost for company B. When the tax authority said the sales is not arm's length, it's not 100, it should be 110. Logically, in company B, their cost must be also 110. So the Ministry of Finance regulation provide the administration or the procedure that should be met by the taxpayer if they want to claim their right regarding the corresponding adjustment. So here, the taxpayer, the company B, do corresponding adjustment. From here, we can see that before, in their tax return, their income tax is 4,400. After the corresponding adjustment applies, their cost increase into 110,000. Their profit decrease into 10,000. Their income tax decrease into 202,000. And because they already paid the tax on the basis of 4,400, there will be additional tax refund. Yeah, in the number of 2,200. The taxpayer can do this as long as they agree with the tax assessment letter and do not lodge any legal remedies. So they do not lodge for the objection or appeal. Yeah, they do not lodge for that. If so, the additional tax burden will be reduced. Yeah, only 1,100. Where does it come? It comes from the VAT adjustment. Yeah. But here in Ministry of Finance regulation, it said that the VAT adjustment do not result in adjustment, for input tax for the counterpart. So it still must be paid by the company A. So that's why the total additional tax burden is still 1,100. So before the tax assessment, the total tax burden is 6,600, and now it becomes 7,700. Okay, this is for local transfer pricing or domestic related party transaction. How if the related party transaction do cross border? How about the cross border related party transaction? I'll give you the simulation too. Next slide, please. So here, for the cross-border transfer pricing or cross-border related party transaction, this is the scenes. Yeah, in Indonesia, there is company B already submit their annual tax return. It said that their profit is 10,000 and the income tax is 2,200. And assume there is a jurisdiction called B jurisdiction where the affiliated parties registered. And here the company, the company B already report their annual transaction, profit is 20,000. Assume that in the B jurisdiction, the tax rate is 17%. So the total tax burden will be 5,600. Okay. So this is before the assessment from the tax authority. Next slide, please. Yeah, and then the tax authority comes. They said that the sale is not arm's length. Yeah, you do the export, but it's not at arm's length price. So there should be correction. There should be adjustment. Same like before, there will be a primary adjustment for 10,000. So it will applies the income tax rate 22%. And then the withholding tax, because of what? Because of the deemed dividend, it is called the secondary adjustment. Assume that the tax treaty between Indonesia and B jurisdiction said that dividend is 10%. Assume like that. And then for the VAT adjustment, the correction will be 0. Why? Because for the export transaction, the rate is 0%. So the total tax burden here is, the total additional tax burden here will be 3,200. And it was stated in the Ministry of Finance regulation, it said that the secondary adjustment can obtain treaty benefit. Okay, next slide, please. Can the company B do some corresponding adjustment? Yes, they can. How? If the local transfer pricing, the corresponding adjustment can be performed through three processes. First one, the correction of annual tax return. The second one through the tax audit process, and the third one through the correction of the tax assessment letter if the company B already audited. That's for local related party transaction. But for the cross-border related party transaction, the corresponding adjustment will be performed through mutual agreement procedure. Yeah. So the mutual agreement procedure, so the company B can lodge their MAP request. Yeah. They said that, oh, my my purchase is adjusted by the Director General of Tax in Indonesia. They said that my purchase is not arm's length. It should be 110,000. So I have to adjust my annual tax return. Such process can be performed using the MAP. So they lodge for the MAP request through their tax authority, through their tax authority. Then the tax authority will come to Indonesian tax authority and do some negotiation. Such negotiation or such process is called mutual agreement procedure. And then if there is agreement here, assume that in this case, the B jurisdiction tax authority agree with the DGT, then the company B can do corresponding adjustment. So here from the simulation, if this case is resolved through MAP, in which the B jurisdiction competent authority agree with DGT, agree with Indonesian tax authority, then there will be tax refund in B jurisdiction because the adjustment of the cost will be increased following the DGT tax audit result. So the total additional tax burden will be only 500. Okay, so this is the simulation of the of the primary adjustment, secondary adjustment, corresponding adjustment, and also the VAT adjustment. Okay, next slide, please.
Sorry, if you kind reminder for your time.
Okay. Yes.
10 minutes. Thank you.
10 minutes. Okay. Please. Yeah, this is the second feature, 1 month. Yeah, 1 month. Is there anyone know what is 1 month? This 1 month? Yeah, this is the period in which the taxpayer provide their pricing documentation once requested by the DGT, once requested by the Indonesian Tax Authority. So how to mitigate the overtaxation risk? How to mitigate such risk, the overtaxation exposure? The first one, we should prepare robust transfer pricing documentation. It's already explained by my colleagues, Pak Salil. If we can provide the transfer pricing documentation which meets the requirement in Ministry of Finance 172 that support the related party transaction, align with the arm's length principle. So it will mitigate the overtaxation risk. Okay. Furthermore, if the tax authority found that the transfer pricing documentation meet the requirement, the tax authority will assess the transfer pricing documentation, and the actual circumstances based on the transfer pricing documentation. Okay, that's the first one. Prepare a robust transfer pricing documentation. Okay, that's how to mitigate the overtaxation risk. The second one. Next one. Next slide, please. Yeah, this is the figure again. 5 years. What is 5 years? 5 years is the maximum APA period. What is APA? I will explain to you. Next slide, please. Yeah. APA is one way to also mitigate the overtaxation risk. How come? Through APA, we can prevent the dispute. Through APA, the taxpayer can get certainty. Why? Because the price has already agreed between the taxpayer and the tax authority in advance. Okay. So if the APA already agreed between the taxpayer and the tax authority, or between the tax authority in Indonesia and the tax authority of the related party, when there is APA, there will be certainty for taxpayer. Yeah, the transfer price is already agreed in advance. Yeah. So the taxpayer will be protected from tax audit or compliance testing by the tax authority. It will provide more certainty. There are 3 types of APA. The first one is unilateral APA. It's appropriate for local related party transaction. And there are bilateral and multilateral APA. It's appropriate for cross-border transaction, and particularly for high-value historically litigated transaction or complex transaction. Yeah, the Ministry of Finance Regulation 172, this is the first regulation which introduced the multilateral APA. And the APA can cover 5 years period, yeah, plus rollback period if it meets the requirement. So you can imagine, if we apply for APA for the year 2025, yeah, right now I come to DGT, I want to launch APA. If the DGT agree with my proposal, with my APA proposal, so I can do the related party transaction for 2025 until 2030 with certainty. Okay, it will be protected by the agreement from me and the Directorate General of Taxes. It can be a solution to prevent the dispute. Next slide, please. Next slide. Yeah. How can we submit the APA? So here I provide you who eligible for APA. Basically, Indonesian taxpayer can submit the APA as long as they meet the APA requirement. So it's the below one. What is the APA requirement? It's already submitted the corporate tax income for 3 fiscal years before the APA period. Required to and has fulfilled the obligation to prepare transfer pricing documentation. Not currently under investigation for tax crime. And the transaction being proposed in the APA has been reported in annual tax return. It's slightly different with the previous regulation. If we see the previous regulation, the one that should be reported not only the transaction, but the counterpart. But here, in the new regulation, only the transaction. And the last one, the APA proposal does not result in smaller operating profit compared with the operating profit reported in the annual tax return. What is the scope of APA? What can be agreed in the APA? First one, the identity of related party. The second one, the covered transaction. You can agree in every transaction, in every kind of transaction, in every type of related party transaction. And the third one, the TP method. The fourth one, how to apply the TP method. And the fifth one, the APA period. And the last, the relevant critical assumption. The maximum period for APA is 5 fiscal years, plus any rollback if it meets the requirement and proposed by the taxpayer. So this is for the APA. It provides more certainty for you and for your related party. Next slide, please. So if the APA already agreed, yeah, by the DGT and the taxpayer, it will be carried out through the decision letter of APA implementation. And the agreement must be implemented by the taxpayer and implement in their taxpayers in their pricing policy and their transfer pricing documentation. And if there is a correction for their annual tax return due to the APA, it will be waived. So there is more incentive for the taxpayer to lodge the APA. It provides certainty. And if there is sanction, if there is an administrative sanction, it will be waived or it will be nullified by the DGT. Okay? Next slide, please. 24 months. What is 24 months? The 24 months is the period for DGT and their treaty partner to negotiate through MAP or mutual agreement procedure. Next slide, please. Yeah. So I want to recall again how to mitigate the overtaxation risk. The first one, provide a robust transfer pricing documentation. The second one, use advanced pricing agreement. Yeah. And the third one, if already dispute, you can use mutual agreement procedure to resolve the dispute, the transfer pricing dispute. Yeah. If transfer pricing dispute already occurred, you can use domestic pathway and you can use international pathway. For domestic pathway, you can use objection, appeal, and judicial review. But there is another alternative. What is that? The mutual agreement procedure. But it applies only for cross-border related party transaction. Yeah? So through mutual agreement procedure, the Indonesian tax authority will negotiate with their treaty partner competent authority. Yeah, they will negotiate and find an agreement how to resolve or how to reduce the double tax. The double tax applies due to the transfer pricing adjustment. Next slide, please. Yeah. Who can submit the MEP request? Yeah, from the Indonesian side, there will be the Indonesian taxpayer because there is transfer pricing adjustment, or if there is any treatment not in accordance with the treaty provision. And DGT can also submit the MEP following up the MEP request for bilateral or multilateral APA by Indonesian taxpayer. If I want to give you some example, if MEP we made it as a ship, in that ship there are a lot of goods. One of goods is to resolve transfer pricing dispute. One of them is to prevent the transfer pricing dispute through the APA. Okay, so that's why there is APA here. APA stand for Advanced Pricing Agreement. Yeah. And the next part is who is eligible for MEP. Yeah. Outside Indonesia, the treaty partner can submit the MEP. So the MEP can be one way to resolve the transfer pricing dispute. Next slide, please. Yeah. How can we submit the MEP requirement? The first one, it should be submitted in Bahasa. Disclose the action. What action not in accordance with the tax treaty provision, and submit it within the time limit as provided in tax treaty. Usually it's the 3 years after the first notification or 3 years after the release of the tax assessment letter. Next slide, please. Yes. After we submit the MEP request, will be the process. The DGT and their competent authority partner will do the negotiation for maximum period 24 months. But it can be extended for maximum 24 months for the next 24 months. Yeah, as long as it meet the requirement. What is the requirement? The requirement is there is already agreement regarding the TP method, who is the tested party. Yeah, so the negotiation just want to negotiate about the arm's length range. Okay, the result can be agreement or disagreement, and then the agreement will be formalized in decision letter of mutual agreement, and such letter will be executed. Yeah, can be directly executed as the basis for tax refund or tax collection. Okay. Next slide. I think this is the last part from me. Yeah. So we can now continue to questions and answer. I'll give back to Mbak JJ. Mbak JJ, please.
Thank you, Pak Kivi, for the insightful explanation. Okay, so now we will continue to our question and answer session. Yeah, we already have several questions here, and the first one is from Ibu Astrid. The question, I think this is for Salil. If there is any related party loan which Indonesia as a lender to the related party in other country, what are the key points that we need to consider in terms to fulfill the TP requirements, since we are in the income side because we are the lender?
Thanks, Jalita, and thanks, Astrid, for this question. I think, I think as Kiwi also mentioned is in his presentation that ALP always has two sides to it. One is the recipient side and one is the payer side. But when it comes to the loan transactions, going by the technical feature, we always find that going by the same arm's length principles, you have to find the simpler transaction to be tested. And largely it is the case when you are borrowing, when you are a borrower. Because as a borrower, you have an opportunity to explore whether you want to buy, whether you want to take loan from A or B. One of those conditions is the interest rate, but there can be multiple factors around it. So to Astrid's question, like, if you were an Indonesian borrower, you would have, tested Indonesian loans, or let's say loans are available in Indonesia, depending on which currency you want to borrow with similar arrangements. Similarly, if Indonesia is lending, primarily you should use foreign tested entity and use the interest rate of your recipient party and try to find comparable companies for those agreement and ensure that it is at arm's length price. But it all depends on which country you are referring to, and I'm assuming if it is not very different from accepted or closer countries, then it will be having a rational interest rate. But to make it simpler, point number one, you should be looking at the borrower, which is your foreign entity, and compare that the interest rates applicable to that agreement from the perspective of your borrower. Let's say if your borrower is in Singapore, then you should try and find Singapore comparable agreements. And I'm assuming that the loan may be in foreign currency or in IDR, whatever. But I'm assuming it will be in foreign currency because IDR is largely accepted in Indonesia only. So use that as a basis. But in case there are alternatives also available sometimes, but this is the best approach for this kind of arrangement.
Okay, thank you, Salil. So we move to our second question. I think this is also for Salil. It's from Ibu Yolanda. Is there any consideration on the margin allowable for intragroup service, such as simple service like an accounting service, legal service, shared service center, for example, such as markup within range 3% until 10%? Is it still accepted?
Okay. Thanks, JJ and Yolanda for this question. There are many. Firstly, before I address this question, there are principles of low value added services, which is recognized by OECD and UN model both. And UN model does not recognize it to that level, and because it's largely a league of developing nations. But if you look at the OECD guidelines, they have a specific chapter on low value added services, and which provides that the services that you mentioned, like accounting, HR, and basic IT services, they can be considered as low value added services, and you may not require to do a benchmarking and may have a markup up to 5%, and that should be accepted by countries in order to avoid disputes. But this is not well accepted by developing countries because some countries, especially in the Asian front or in the developing countries, have a large number of BPO centers and other similar activities. And usually the reason for not accepting by the developing countries is because in the name of BPO, sometimes many companies were providing more advanced services, maybe in the nature of knowledge process outsourcing and others. So that is why the developing countries do not have a stand on this safe harbor, as so-called safe harbor of 5%. And they expect that every service needs to be benchmarked, separately to it is again a conscious call depending on the value of your service, but you have to benchmark it separately from the context of Indonesia and many developing countries.
Okay. Thank you, Salil, for your question. For your answer. And we have the third one is from Pak Windu K. Jati. I think this is for Kivi. Why is the secondary adjustment for overseas transaction is 10%? Is it assumed as deemed dividend? And what if it is treated as service with tax treaty Article 26 0%?
Yeah, thank you for the questions, Pak Windu. In our simulation, we assume that the special relationship is occurred due to the shareholder, due to the ownership. So if the special relationship is occurred due to the ownership, so the discrepancy due to the implementation of ILP by the tax authority can be treated as dividend. That's why we use the rate of 10%. But if the special relationship is caused by other than the ownership, maybe because of the control or because of the familiar relationship, so it will be debatable. Yeah. Domestically, it treat the secondary adjustment as dividend, but it's domestic regulation. But for the tax treaty implementation, so we should see again, does the secondary adjustment in Indonesia can be categorized as a dividend based on the Article 10? So there will be some discussion on that. But in short answer, I can give to you right now in our perspective is dividend already limited in Article 10. Yeah, there are already definition of dividend in Article 10. Yeah, in short answer, the dividend is some remuneration because of ownership. So how about the other cause of the special relationship, the control or the blood relationship? Is it included in dividend? Based on our analysis, it's not included as, or it cannot be, it's not included in the dividend definition. So if you said that, can we treat it as service with tax treaty 0%? Yes. Or maybe other article, other income maybe? Yes. Because what? Because there is no, for now, until now, there is no limitation on that. So if you want to say this is business service, why? Because it's not dividend. The Article 10 said that dividend is due to the ownership. So like I said, it's quite debatable. Maybe that's my answer. Salil, if you have any additional comment?
I think it's a very tricky question, and I agree with you, but I also believe from the perspective of Windy that because let's say if my intercompany transaction was, let's say, service, and then let's say the service is coming from Singapore, it may not be subject to a withholding tax, right? So if the adjustment happens to service value, then it may not have a withholding tax, or certain cases like that. But I believe that as Kiwi pointed out, you can draw an interpretation, but I am assuming that tax officer will consider it as payment passed on to the group companies because that will be a stronger argument if they want to dispute. You know, that would be my take. But I have one more point that maybe if this is not direct shareholding, maybe they will also look at indirect shareholding to check whether the ownership criteria are fulfilled. But yeah, I agree with Kiwi's points.
Kiwi, thanks, Salil. We have more. Actually,
Yeah.
sorry, Salil. The next question is in Bahasa Indonesia and wish to be answered in Bahasa. So, if you don't mind.
Maybe, no worries.
Okay.
If you want me to answer, maybe you can translate in English. But if you want in Bahasa, we have both you and Kiwi.
Okay. I think Kiwi can answer ya in Bahasa.
Yeah, okay.
Bu Leni wish to be answered in Bahasa. Oke, apakah boleh dijelaskan lebih lanjut terkait penambahan metode TP berdasarkan PMK 172 seperti CAT, penilaian harta berwujud, dan penilaian bisnis?
Ya, terima kasih banyak Bu Leni. Mengenai penambahan metode transfer pricing, sebenarnya tidak bisa dibilang juga ditambah, karena di aturan sebelumnya, di PMK 22 tahun 2020, metode ini sudah ada. Jadi kalau kita lihat di PMK 172 dan PMK 22, relatively untuk metode transfer pricing tidak banyak perubahan. Jadi comparable uncontrolled transaction atau CUT sama penilaian atau valuasi sama-sama ada di PMK 22 tahun 2020 dan juga sama juga ada di PMK 172 tahun 2023. Nah, kapan metode ini dipakai? Pakai CUT kapan? Pakai harta penilaian kapan? Pakai di dalam PMK 172 di situ dijelaskan CUT itu sebenarnya mirip seperti CAP ya. Bedanya kalau CUT itu persen, kalau CAP itu dia rupiah. CUT itu cocok digunakan untuk transaksi, umumnya digunakan untuk transaksi terkait royalti atau bunga pinjaman, provisi atau komisi. Jadi maaf, dalam PMK 172 itu sudah dijelasin transaksi apa yang cocok menggunakan CUT. Nah, bagaimana dengan valuasi? Valuasi harta berwujud dan juga penilaian bisnis. Nah, dalam PMK 172 pun sama, bisa menggunakan valuasi di situ, penilaian harta berwujud, penilaian bisnis, itu juga ada transaksi-transaksinya. Misalnya, untuk transaksi restrukturisasi bisnis, nah itu bisa pakai metode valuasi. Jadi, sebenarnya penambahan enggak gitu ya, Bu Leni, sama aja sama yang lama, ya ini lebih ke penegasan saja. Gitu kira-kira.
Maaf, ini ada tambahan juga dari Bu Leni.
Oh ya baik.
Terkait corresponding adjustment, bagaimana prosedurnya apabila transaksi afiliasinya dilakukan dengan lebih dari satu pihak dan dilakukan dalam lebih dari satu jenis transaksi.
Ya.
Misalkan ada penjualan, pembelian, pinjaman.
Ya, terima kasih Bu Leni atas pertanyaannya. Nah, bagaimana kalau misalnya transaksinya macam-macam gitu ya? Correspondingnya seperti apa? Apakah barangkali mungkin mikirnya apakah langsung diagregasi semua atau di satu-satu kan begitu? Nah, saya pikir di PMK 172 belum ada penjelasan lebih lanjut terkait hal ini ya, terkait bagaimana corresponding apakah digabungkah ataukah dipisah sesuai dengan jenis transaksi. Ya prinsipnya sebenarnya dalam transfer pricing kan transaksi itu dianalisis secara terpisah kan gitu, disegregasi, bisa diagregat kalau misalnya saling terkait dan saling mempengaruhi. Tapi kan itu untuk penerapan ALP-nya. Nah, correspondingnya ini seperti apa? Apakah ikut itu ataukah ada metode lain? So far belum ada pengaturan. Ya, belum ada pengaturan lebih lanjut. Jadi clearly menjawab berdasarkan PMK ya belum bisa. Kenapa? Karena di PMK belum ada ngomong seperti itu. Apalagi di PMK, di situ kalau kita lihat, corresponding adjustment yang diatur di PMK 172 itu corresponding adjustment yang dilakukan oleh otoritas pajak. Nah, jadi kalau prediksi kami adalah akan ada aturan-aturan lebih lanjut dari teman-teman di Direktorat Jenderal Pajak terkait bagaimana mengaplikasikan corresponding adjustment ini. Ya, kalau sekarang ya kita belum bisa menjawab. Kenapa? Belum ada keterangan bagaimana melakukannya dalam PMK 172. Begitu. Dia cuma bilang ya silakan lakukan ya yang ada di situ, yang di PMK 172 itu cuma prosedurnya. Bisa pembetulan, bisa melalui proses pemeriksaan, atau bisa melalui pembetulan SKP. Sebatas itu. Terus triggernya apa? Triggernya perusahaan yang kena imbas itu memberikan pemberitahuan tertulis, memberikan notifikasi tertulis kepada KPP tempat dia terdaftar. Nah, bagaimana caranya dilakukan corresponding tadi? Nah, itu belum ada. In detail seperti itu. Jadi ya, untuk memberikan more certainty for the taxpayers, yes, ya kemungkinan besar akan ada peraturan turunan atau peraturan lanjutan dari teman-teman di Direktorat Jenderal Pajak. Gitu kira-kira.
Okay. Thank you, Pak Kivi. Okay, for the fifth question, yeah, from Pak Rahmat Akbar. If APA is rejected, how about the data that we gave to DGT in the first place? Is it safe from tax audit findings? Maybe we have...
Maybe one more point to add for Kiwi. Kiwi will answer this. And is there any regulation which prevents the data to be used for any other purposes?
Yeah.
Yeah.
Yeah. So for the question from Pak Akbar, thank you Salil for the also actually Salil already answer.
But that's why I'm saying they add on
Yeah.
because I think I don't think that they can write anything like this, but maybe to double check with you.
Yeah, there is the article in Ministry of Finance Regulation that prevent the DGT to use the APA data to use it if the APA is not concluded, or if there is a disagreement, the DGT cannot use the data for the tax audit or the compliance testing. So it is protected by the treaty provision. It's confidential.
And just to add on to Kiwi's point, maybe Kiwi, you can also explain because you have been with DGT for a long time, so you can probably provide a more valuable, viewpoint. I also believe that the DGT team and is quite separate. So so there is of course confidentiality that needs to be maintained, and if they start sharing the data, then nobody will entertain. Nobody will go into APA because
Yeah.
this will be the big concern. And maybe Kiwi can elaborate more. There will be separate tax officers who are in charge of APA team, and there are separate team who is doing routine tax audit. Maybe Kiwi, you can just confirm.
Yeah, thank you Salil for your reminder. Yeah, maybe some of you has not known me. Yeah, I worked previously in Directorate General of Taxes for most of my career. So in my previous experience, I also handled the advanced pricing agreement. So based on my experience, if there is a disagreement between the DGT and the taxpayer, or between the DGT with their competent authority, such data is confidential. Yeah, it cannot be used for the tax audit process. Yeah. Like Salil said, if it can be used for the tax audit process, so why should we launch the APA? So it is protected by the tax law regulation, and it also be stated in the Ministry of Finance 172 regulation. There is an article said that if there is the disagreement, the data cannot be used for the tax audit process. Thank you.
And Rachmat, this is Pak Rachmat, this is across, not only in Indonesia. APA is always a separate team from routine tax audits to instill the confidence in taxpayers to opt for APA. And Indonesian tax office has been also promoting, some of our tax officers also say that why don't you go for an APA? Because we are always debating in some cases on certain issues. So they say, why not go for an APA and resolve it 5 years at a time? Yeah. Okay.
Okay, thank you, Salil and Kivi. Our sixth question from Pak Rudi Chandra. I think this is for Salil. We, parent Indonesia entity, as a creditor, provide shareholder loan to our subsidiary in Australia. Since the debtor is in loss position and have financial difficulties, can we charge 0% interest on the shareholder loan? Indonesian tax, Indonesian tax auditor can the Indonesian tax auditor challenge this? Can we argue that the debtor cannot pay any interest, hence there is no corporate income tax payable in Indonesia, since the CIT payable is from offshore is a passive income in cash basis?
Okay, thanks, JJ and Rudy, for this question. So I think that brings me back to the presentation and the regulations. So the question is whether with this intent of charging 0% loan, does it meet the characteristics of a loan? This is the first question that needs to be answered. Because if you remember in the presentation, I mentioned that the borrower should have the ability to borrow the loan and pay the loan and interest at the time of maturity. So with this, with your facts, I don't know whether you will be able to clearly establish, because that's the guidance that we will practically understand that you need to observe. And if it does not meet those tests, then it may be more, there is a tendency that the tax officer may consider it as an equity. That's my take. Maybe Kiwi, if you want to have if you have a different view, maybe you can just share.
Same with you. No other comment.
Okay, thank you, Salil and Kivi. We move to this is our last question for this session because time also already 15:51. Okay, the seventh question is from Pak Asikin. Is there any regulated transitional provision on ongoing MAP, PMK 49 and APA, PMK 22, where the decision letter has not been issued prior to new PMK 172 comes into effect? Maybe this is for Kivi.
Yeah, thank you for Pak Asihin ya, Pak
Yeah,
Asihin,
Pak Asikin.
for the question. Is there any regulated transitional provisions? Yeah, there is transitional provision in PMK 172, but regarding the MAP or APA, I think after the issuance of the Ministry of Finance Regulation 172, the PMK 47 and PMK 22 is already revoked. But for the administration procedure between PMK 49 and PMK 22 and PMK 172, there is not so much difference. So there will be, I think that based on my experience, there will be not so many issues about the transition. Maybe that's the answer.
Thank you. Thank you. I see that we have two more questions here from Pak Irsat and Ibu Denia. Maybe we can answer that ya, Kivi and Salil. Okay. From Pak Irsat, Traveloka. Maybe this is for Kivi. Why does the secondary adjustment for domestic transaction applied with secondary adjustment with 15% rate of Article 23 if the Article 4 paragraph 3 exempt the income?
Yeah, thank you, Pak Irsyad, for the question. I think the dividend which exempted by the domestic regulation has already requirement. Yeah, one of them is it is distributed from the retained earning, and it it is distributed based on the general meeting of the shareholder. And I think the requirement is not met by this secondary adjustment. So that's why it is applied the 15% tax rate. Maybe that's the answer.
Yes, thank you. And this is our last question from maybe Ibu Denia. I think Salil can answer first, and then Kivi will add. Post-Tax Harmonization Act, which followed by the issuance of PMK 172, seems the interpretation of transaction which influenced by special relationship is being broadly defined. For example, independent transactions, but influenced by the special relationship. The question is it common for country to use those approaches? Understand that despite the global guidance from OECD, any countries have their local adoption. Just wondering whether the approach taken by Indonesia is commonly applied. And B, and how both taxpayer and tax authority identify and prove that there is indeed an influence in special relationship in independent transaction. What would be the basis or the variables? In practical areas, taxpayer may have thousands of independent transactions, making it difficult to address the issue.
Thanks, Denia. I think this is an interesting question, but I think the first question is it common? Yes, it is common. And are there any countries who have adopted this? I can talk about India. India has a regulation related to deemed international transactions specifically. So they have given even some examples of what is considered as deemed international transaction. And if my memory serves me right, Australia also has deemed international transactions, and maybe some other countries, some developed countries also have. So how it works, like you in the question B, how they identify an example, I can give you through an example because there could be several number of cases, as you mentioned, there may be thousands of these kind of transactions. So let's say if you have, a transaction which Indonesian entity carries out with a local supplier or a local customer, but the pricing is determined by your foreign affiliate, but you don't enter into, the invoice mapping that way. So that way it remains indirect, but it has an influence on the pricing. Because maybe let's say assume the case that the contract for the discussions, emails or negotiations are happening excluding Indonesia, but Indonesia is the party who is honoring or providing support or honoring the commitment. So those are typical cases of those situations. So I assume that in those cases, how it is practically applied, usually if this is a very important transaction, then the tax officer sometimes get to know about it based on maybe your VAT filings or some kind of any kind of data, where you cannot have a limitation to it. Maybe they can also check it from the returns of your supplier, let's say, that at what price they are providing to other customers or other suppliers, and what is the price they are offering to you, and that could be a starting point for consideration. And all these points where I'm mentioning it is based on some of the experiences that I've observed in many countries. So this could be something which could be there, but of course there will be no fine print on what is the basis that they have used. But they can ask you, because as a tax officer they have a right to ask and ask what is the basis for your transactions with the supplier, and if not answered appropriately, they could read a deeming fiction into it that it is influenced by some of your related entity. And this is common in Indonesia, where certain industries, they have their supply chain team sitting in Singapore who is negotiating and doing most of the transactions for them, but they are not entering into a separate contract. So these are some of the cases that can be there. Does it help answer? I think maybe we can connect later, Dinya, in case it's unresolved.
Is there any additional from KV?
Kibi, do you have any additional point?
Yeah, maybe I just want to add the B questions. I just want to add answer for B questions. How both taxpayer and tax authorities identify for the transaction between independent transaction but influenced by special relationship. I know it in practically it will be difficult for both, for the taxpayers and also for the tax authority. From my experience in my career as the in tax authority, to prove that the one of the document is the contract. If the tax authority can find the contract that already determine the counterpart and the price, so there should be two requirements met by the taxpayer, yeah, to say that this independent transaction is influenced by the special relationship. Yeah, so the related party should determine who is the counterpart, and the related party should also determine how much is the price. If one of them is not meet in the contract, so it is not in the scope of arm's length principle. So what is the document, or how in practical? So we use the usually we use the contract. We see the contract. If the contract between assume the parent and the other party said that my subsidiary will do transaction with you with the price assume that with the price 100. So this is the contract will be the basis. Will be used as the basis to include that in the independent transaction influenced by the special relationship. So maybe that's my additional answer.
Yeah, and that's why Dinya, the language used is influenced, because influenced is a very large word and large
Yeah.
term which can be used in multiple instances. Like I think, in fact, as I mentioned, in some countries you have to even report documentation and prove arm's length pricing in the documentation itself for deemed international transactions. I mean, but Indonesia has domestic transactions, so it can be ruled on to domestic transactions also, but largely this is how it reads. And maybe I think since we have run out of time, any final thoughts, Kibi, you want to give?
Final thoughts?
Yeah.
Yeah,
Any final
it's already
thoughts?
4, yeah.
Yeah.
Yeah. Maybe I can say that the Ministry of Finance Regulation number 172 is already provided and is already provided more certainty for the taxpayers, but it is realized that some issues raise some questions. Yeah, but it's for technical issues like the how to correspond adjustment, something like that. How what is but it's from the technical or administration issues. But in general, this regulation has already provide more certainty for the taxpayers, and it provide more incentive for the taxpayers to submit the advance pricing agreement to prevent their transfer pricing dispute, because this facility it's good for the taxpayer. Once it's already agreed, the taxpayer can be protected from the tax audit or for the tax audit for transfer pricing. Yeah, so maybe that you can now prepare more, yeah, to plan your transfer pricing. And also maybe one thing is this regulation now give a strict time limit to provide transfer pricing documentation. It's only 1 month after being requested. So you should prepare, the earlier preparation is better. Yeah. I think
In
that's
fact,
my final thought.
I would advise the clients not to wait for that 1 month, and you should rather do it within the prescribed time limit itself. That will
Yeah.
give better acceptability to the documentation. My final thoughts are again based on my discussions with clients over a period of time. They are okay to adjust their pricing provided it provides tax certainty to them. And I think as Kiwi also mentioned, these regulations may help address some of it, but I still believe that there are so many things with the added tax will create even more confusions, and time will tell how much it has improved. One thing is very vital for me, which is based on purely my interpretation, that APAs last year might be less because of the conditions that Indonesia has about the last 3 year profitability, and I believe 2020 and 2021 was impacted by COVID, and maybe then accordingly your 2020 2019 results became, if it was very indifferent from 2020 and 2021, had a role to play. But here in the current year, maybe APA could be a good opportunity to spell a lot of doubts around, and this is also favored by tax officers where you have a repeated litigation on same issues to get certainty. I think that's it from our side. Back to you, Jalita.
Thanks, Salil and Kivi. I believe this is the end of our TP webinar today. I'm very sorry if there is any question that cannot be answered because the time is very limited. Maybe if you still have any question, you can drop us a message. Thank you for all of your attention and question today. Don't forget to give your feedback to receive our material today. Thank you, Salil and Kivi, for such interesting and insightful presentation. And see you again in our coming webinar. Good afternoon and have a good day.
Thank you.
Thank
Thank
you.
you. Thank you, everyone.
Thank you.
Have a good
At RSM, we instill confidence in a world of change. Because when you have confidence, you can act with complete conviction for the future. And in our ever-changing world, with transformation happening at a rapid pace, the depth of insight and understanding we bring matters most. At RSM, we believe the biggest opportunities are found by paying attention to the smallest details, finding difference through understanding, and anticipating the challenges of tomorrow, helping build long-term value today. At the heart of RSM are our people, whose talents, ideas, and energy drive us forward. A collective of 60,000 curious minds, pushing innovation in over 120 countries. Combining local knowledge with global insights, we harness data and real-world experience, building trust that's unmatched and confidence that grows, working together to look further, giving you what you need to take charge of change.